And what happens when the market crashes?
So I would definitely look at JEPQ as a competitor. If volatility spikes, then income goes up.
So which one do you think had the highest total return? Garrett, your new QQQI ETF generates monthly income selling covered calls on the NASDAQ 100, but it's not the only one. There are others doing that as well. You've got JEPQ, QYLD, and FEPI, FEPI. So my question is, are you ready for some compare and contrast?
Yes, looking forward to today's discussion and hopefully can give some good insights to your audience.
Well, I'll assume that everyone's already familiar with QQQI because we did an episode on that in our last interview. But if you missed it, I'll link that in the description. We're going to start by looking at JEPQ, which has over $11 billion of assets under management. They're a huge player in this space. JP Morgan actively manages about 100 stocks in that portfolio, but it's not the same 100 as the NASDAQ 100. They're able to select from other exchanges as well. For example, you got Chipotle, which is from the New York Stock Exchange, Lowe's, the hardware stores from the New York Stock Exchange. Their option strategy is, though, to outsource that part of the fund to banks using a financial instrument called an equity-linked note, or ELN. So with that basic summary out of the way, would you consider JEPQ to be your biggest competitor for QQQI?
So I would definitely look at JEPQ as a competitor, given the fact that they're looking to try to replicate and give exposure to NASDAQ 100 stocks, although being actively managed. The way we look at QQQI, though, is to give you pure exposure to the NASDAQ 100 index. And then the option strategy is different. But as you know, when we're out talking to investors, JP Morgan is very much a household name and everybody knows them. So we tend to, run into a lot of JEPQ investors along the way, or their other products, given just the swath of what JP Morgan is. And so we're looking at using index options linked to the NASDAQ 100 versus the equity linked notes that you referenced. And then we also look to fully replicate the actual NASDAQ 100 index. So those two variations give you what could be a competitor, but definitely some differences in how the funds and the products are managed.
So just to clarify, they're choosing stocks because they could adjust the weighting of the stocks from the NASDAQ 100, or as I mentioned earlier, pick stocks from outside of the NASDAQ 100. So it is a stock selection process for them. Some people like that, some people don't. You're not a stock selection group, right? That's not your thing. Your specialty is the options part of it.
Correct. Yes, we're an option specialist. We focused our entire careers on managing option-based strategies and really focused on that overlay piece. For us, we like to give investors their exposure to their actual benchmark.
Right. And they're using the ELNs that I mentioned before. You don't use those in any of your funds, is that right?
That's correct. We use all index options. And one of the main reasons is they get a tax beneficial treatment from the IRS. So 60% of any of our returns or income we generate are taxed at long-term capital gains and 40% at short-term, versus an equity-linked note or some other type of swap or synthetic option that's ultimately going to get taxed all at ordinary income. So we like to have the index options that are listed. They're very liquid. They're publicly traded on the major exchanges, and they also have tax beneficial treatment.
Okay, so the tax efficiency, I think, scores higher for QQQI than for JEPQ on this one. One similarity, though, is that they write their calls out of the money through the ELNs, and you do as well.
Yes, that's correct. We ladder multiple different calls, and all of those calls will be out of the money for us. We look to try to have that as an advantage to capture upside in the underlying NASDAQ 100 index.
That's not the case for the next one, because the next competitor is the granddaddy of NASDAQ 100 covered call funds, and that's QYLD. They've been around since 2013, over 10 years. They're also a major player. They've got about $8 billion assets under management. And this comparison, I think, is a little simpler because their strategy is pretty black and white. They just sell at-the-money calls on 100% of the portfolio. And this one is passive. It just follows the formula. So the fund managers don't choose the stocks and they don't manage the options. So the obvious question is, what exactly do they do all day?
So the fund managers that run any passive index-based product are going to either track the index, meaning they're going to still go out and replicate the NASDAQ 100 equities as the index designates them to do. They're going to sell that at-the-money call when that index tells them to do and which one to do that. So it's really trade execution. And then, of course, if there's any inflows or outflows on a product, but they're not, as a manager, actively choosing their positions, as you had mentioned, either on the equity side or the options. They're simply there to execute and track the index that was created from flows coming in and out of the funds or when that index makes an ultimate change.
It sounds a lot easier, though, than an active fund.
Yes, they are easier. Passively managed index products are much easier to manage than active funds.
All right. So QYLD is passive. We've established that QQQI is active, but it's rules-based. So can you explain that difference? Active but rules-based.
Let's say volatility is low and we have a target income that we want to generate on the fund on a monthly basis. We might be overlaying more options on the portfolio in those lower volatility environments. But when volatility gets high and the market is sold off, we write on less. So really our model, although it has rules and it's set, it's very dynamic, looking at several aspects of the options market and the equities and the relationship of the two to be able to dynamically shift the strategy to how far out of the money the calls are being written, how much of the portfolio we're writing on. And so there's several other factors that get you to the ultimate strategy. And so although the rules are set, that does change as the market shifts and changes based on its volatility and returns.
So you're not just making these option trades from the seat of your pants. It's you have some guidelines that you follow, and that makes a lot of sense. Now, there is a similarity, though, with your fund, QQQI and QYLD, which is they both distribute return of capital, which you mentioned earlier is tax efficient. So that's a plus. One of the negatives, though, for me, or criticisms, I guess, I have of this fund, QYLD, is that they sell at the money because it limits the upside. So is that something that you would see as a negative, or is there any benefit to selling at the money?
So there's limited times where the benefit of selling in at the money makes sense. I would say if you think we're going to be in a consistent downward trend in the equity markets with no reversion back or any upside, then selling in at the money in any type of option strategy might make sense because you're generating a significant amount of income with no upside. However, if we ever look at history and kind of the law of averages and probability, the market tends to go higher, or at least if it's had a sell-off, it does eventually come back. And so selling out of the money options are always historically the best return profile when you can institute a covered call strategy, because you're able to, again, marry that upside appreciation with your income generation, which over the long term, certainly as we see by looking at history, outperforms in at the money strategy.
And we'll get to history in just a minute. One other similarity, they do reinvest some of the income they generate back into the fund, which either reduces NAV erosion or, I guess, helps it. There are situations you mentioned in another interview where you'll do that too, right? Where if you generate more than anticipated in terms of investment income, you'll reinvest it back into the fund. Is that right?
Yes, that's correct. So if there's a time where volatility is higher, we already meet our income threshold for the fund, and there's excess income being generated from the options, we reinvest that back into the fund, meaning the equities and everything. So that helps compound, long-term growth, so that you're not just either over distributing or distributing excess income on a monthly basis to investors, or it's not sitting in the fund as cash. It's reinvested in order to, participate in growing the net asset value of the fund.
I want to mention something else. The three funds that we've talked about so far, JEPQ, QYLD, and then your QQQI, all have something else in common. They all have sister funds that follow the same strategy, but on a different index, that different index being the S&P 500. And there's more data to look at if we study those sister funds. So I looked up the total returns for those three funds that follow the S&P 500, going back to when SPYI began, which was August 30th, 2022. Is that right?
Yes, that's correct.
Yep. So which one do you think had the highest total return?
Well, I kind of know the answer to that just because we watch everything so closely here, ourselves and our competitors. So I might let you go back and not spoil, the answer, but I have a good idea of which one was the best performing app.
Oh, okay. 'Cause I was going to say that you came dead last, but that's not the case. So XYLD came in third, probably not a shock. JEPQ came in second, and you're right, SPYI came in first with the highest total return. Do you think over the longer term, because QQQI is pretty new, do you think that these NASDAQ funds will end up ranking in a similar order?
I do, because the methodology across all three issuers are the same, right? So each one of us are still just taking the same underlying investment philosophy and just overlaying them on different indexes for investors to, espouse their views. So we're really excited about QQQI, and the growth prospects, for the returns for shareholders in that. And we've already seen that very similarly since we've launched the product just a few months ago. We have seen that same, kind of structure of return, income profile, relative to obviously our sister fund and in comparison to other issuers' funds as well.
I want to ask you about one other fund. It's new, but the numbers it's put on the board so far have been pretty impressive. It's getting a lot of attention. And then we can talk about fees at the end. So the next one is FEPI, FEPI. They've only been around for a few months. But the assets under management already approaching 200 million, so that's impressive. And the reason, as I said, I want to ask about them is that the numbers look good. If you annualize the distributions, it comes out to over 20%, which is crazy high. And normally if you see a yield that high, there would be a lot of NAV erosion. But the price of the ETF, as of today at least, is still higher than when it was initially launched. So that's impressive. And this fund is a little bit different from the ones we've been talking about so far, because even though it comes from an index that's based on the NASDAQ 100, it only selects 15 stocks, which is much smaller than 100, obviously. They do sell out of the money covered calls like QQQI, but not on an index, on individual stocks. So the last, I guess, similarity would be that they say they issue return of capital. We won't know the amounts probably to the end of the financial year. So what are your thoughts about this one? I know it's new. Maybe there's not as much information about it, but any thoughts on how it compares to QQQI?
Sure. So as we talked about before, starting with the equities, right, we're along the full NASDAQ 100. We have all 100 plus equities in their exact weightings. FEPI, which you had just mentioned, you said selects 15 stocks. So that's a big difference. You're taking a concentrated equity bet on whatever those stock selections are within, I believe, tech and innovation. And so I think to the performance side, there's been a really good run in not only the equity markets as a whole, but specifically in tech since the lows back in October of last year. And so in any covered call strategy, right, a significant portion of your general return of the fund is really going to come from the equities. And so you're taking certainly a bet, whether it is like QQQI of the NASDAQ 100 directly, whether that was FEPI and their 15, stock selections and however they select those equities. That's going to be the core part of maybe a differentiation across any one of these products is the equity exposure. Certainly on an option side, again, we feel the index options are when we can. We really want to use index options because of their tax efficiency, their liquidity, their exposure to the underlying broad-based index. On a single equity option, as long as your holding period is less than 12 months, which is, I think, what most managers really look at, selling an option for longer than a year is a really long time period to guess where that underlying exposure is going to be. But the equity option then is taxed at all ordinary income. So income being generated off those options that I guess is not classified as return of capital would all be short-term capital gains being ordinary income.
And what's interesting about the index they use, which is from Selective, the German company, is that it's equal weighting for the 15 stocks. So with the NASDAQ 100 index, it's by market cap. So obviously the smallest company has less of a percentage of the total portfolio than the bigger ones like Apple and Microsoft. But with the FEPI fund, the smallest of the 15 gets exactly the same weighting as Apple or Microsoft. Not necessarily good or bad, but just worth knowing about that fund. And regarding return of capital, like I said, I've seen reports that they distribute some, but we don't know how much yet. There's more of a history with your SBYI fund, obviously. So it'll be interesting to see how that washes out because of what you said about indexes versus individual option trades. Let's move along now to what some people love talking about, maybe too much, but that's fees. It's a hot topic. JP Morgan and Goldman Sachs got a lot of coverage when they started charging 0.35% for some active funds like JEPI and JEPQ. A lot of people liked that. Are larger funds able to operate with lower fees?
They are. So as you can imagine, just taking JP Morgan, any major bank, a lot of assets, a lot of revenue. And that also comes with the ability to have some pricing power when you're issuing an ETF. I know we did an earlier interview just talking about the costs of launching ETFs. And it is very much true. As the firm as a whole has a lot more assets that it manages, it gets lower fees from service providers. Obviously, the more boutique managers, are going to have a higher fee structure. They have less pricing power. Same goes for almost any industry.
Right. And even though it's a low fee, it's not like they're starving. I mean, JEPI's about $32 billion. So even 0.35% of that, still over $100 million. It's a lot of money, really. So all the numbers make sense. Are there any advantages from the investor perspective to investing in smaller fund companies like yours versus the big ones?
Yeah, absolutely. You're getting a manager that really focuses its efforts. So for us here at NEOS, right, NEOS actually stands for Next Evolution Option Strategies. And so all we do are options. That's what we've always done our entire careers. So you're getting a manager that focuses exclusively on delivering the best investment results it can, directly on a segment that we want to be promoting, which is option-based strategies. Of course, whether that's JP Morgan or any of the other major issuers that are out there, they have products across all types of strategies, from equities to emerging markets to fixed income to government treasuries to all sorts of different areas. We focus exclusively on delivering option-based strategies where you can get, I think, the boutique managers delivering, better performance, overall, and obviously certainly focus. And the one thing I'd also add about fees are, fees should be relative to the return profile, I think, of the fund in general. What's the risk and return that a client is taking relative to their fees? That's something that we really focus on here. We actually have products in those 30 basis point levels, but they're on more of a cash-like type of a strategy, something much more lower risk in your portfolio. And then ultimately, we feel that the boutique managers and us can really offer that type of a focus, and a good product. And if you're looking at our returns relative to competitors, that's another opportunity that 30 basis point or so difference didn't make much of an impact when you're thinking our fees last year versus our performance. We were anywhere between, for SPYI, that is, taking that longer history, anywhere from 4 to 9% of additional return against all of our competitors. So we significantly outperformed from a return perspective, even net of those fees.
Yeah, that's a good point. If you outperform by a margin that's significantly greater than the fee difference, then for the investor, that makes a lot of sense. So we've covered a lot of technical differences between QQQI and FEPI, QYLD, JEPQ, and it can get a bit overwhelming. So I'll give you my really short version of, I guess, what differentiates QQQI. I would say that it's ideal for investors who like the NASDAQ 100, the index, as opposed to funds that are individually picking stocks, and want a fund manager who is specialized in options, given that we're talking about covered call strategies, as opposed to a fund manager who's a stock picker. That's not really something you'd probably put in your marketing materials, but that's what I see as the differentiator. How would you, if you're in the elevator pitch and you're giving the really short version of QQQI, how would you explain what makes it different from the other ones?
Yep. So I would summarize it again, like you did. On the equity side, we're giving you exposure to the NASDAQ 100 versus a stock selection process. And then we use the index options linked to the NASDAQ 100 versus an equity linked note or a single stock option, and that's going to be more tax efficient. And so you're thinking about not only the total return and exposure you have, but what is the net after tax return that an investor is taking home. And so those would be the two quick key differentiators that people should be looking at.
Right. And there's no one that says you have to pick one and go all in on that. Personally, I've currently got some JEPQ, I've got some QQQI, I've got some FEPI. I don't have any QYLD, but I know a lot of investors will invest in many of these. But it is important to understand what each one does. Last question is the juicy one. What happens when the market crashes? And we discussed this a little bit in that interview we did about the risks of covered call funds, but I just want to touch on the concept of volatility, all right? So let's say there's a correction, it's 20% down, the market's red, everyone's crying. The value of the portfolio is down, you've got a smaller asset base that you can use to write options, to use to generate income. That's a negative. But there is the positive, which is volatility is probably going to spike, and the effect of that would be what?
Yes, if volatility spikes, then income goes up. So the fund is able to generate more income from the options when the equities are lower if there's been a correction. And so I think one thing that we look at, as we talked briefly about, and I'll be very short on, is that inverse correlation between equities and volatility. So if volatility is low, equities tend to have been higher. If volatility is high, it's because equities are lower. And you want to look at that correlation when we run our strategies to make sure we're delivering, income relative to what the total return of the fund is. And so after a correction, we're trying to still generate as much income as we can for the portfolio.
So you've got two opposing forces there. If the market's going down, the value of the portfolio is going down, you've got the smaller asset base to generate income, that's bad. And then you've got the high volatility, higher income, that's good. They could counter each other out. I guess it depends on the nature of the correction. Is it like a V shape, a J shape? Is it over 3 months? Is it over 15 months? All of those scenarios would produce different results, and perhaps this is something we could get into in more detail in a different interview.
That's correct. Yes, all those different factors would come into play, but in general, the positive side of the covered call strategy is that, yes, if the market is corrected and volatility is higher, and let's just say maybe it stays flat, take one example for today's discussion, right? That option income you're able to generate will help you get your returns back quicker if the market, meaning the equities, don't go back higher. So that is an advantage to these types of products, is that you're able to generate that income from the volatility, even if the equity markets don't come back, quickly.
Well, I realize it's not the easiest thing to talk about your competitors in a public forum like this, because you have to kind of choose your words carefully. So I appreciate it. Thanks for doing this, Garrett.
Thanks for having me today.
And if you want to know more about how QQQI generates its income, we covered the basics in a previous interview, and also the third interview in this 3-part series was all about going behind the scenes of the launch of an ETF, how that's done, how it's created, who gets the fees, etc. And I'll put links to both of those interviews in the description. More Armchair Income coming soon.